Welcome to The Explainer. Look, today we're going on a mission to completely transform the often chaotic, totally overwhelming world of technical analysis into a clean, highly actionable system. If you've ever stared at a price chart and just felt frozen by a barrage of conflicting data, trust me, you're in the exact right place. Today, we're cutting through all that noise and giving you a repeatable framework. Let's kick things off with a pretty jarring reality check. A staggering 95% of traders lose money using technical analysis. But why is that number so incredibly high? Well, it's definitely not because they lack data. Honestly, it's because they have way too much of it. Most beginners fall squarely into the trap of analysis paralysis, kind of just assuming that crowding their screen with every tool ever invented is going to magically print money. It's literally like a soup with too many chefs, you know what I mean? When you slap dozens of conflicting indicators like RSI, MACD, Bollinger Bands all onto a single chart, you completely ruin the recipe. The soup tastes terrible, and your trading results are going to reflect that exact same confusion. Actually, if you ever get the chance to peek at the monitors of professional, consistently profitable traders, you'll notice something surprising. Their screens are remarkably clean. Less truly is more here.
So here is the 4-step MAE trading blueprint we'll be using. Step 1, market structure. Step 2, area of value. Step 3, entry triggers. And step 4, planning exits.
Okay, let's dive right into step 1, market structure. This essentially answers the foundational question, what exactly should you be doing right now in the market? You probably already know the basic structures: uptrends of higher highs, downtrends of lower lows, and range-bound chop. The framework rule here is strict, though. You have to identify the path of least resistance and fully commit to it. Uptrend, you are only looking to buy. Downtrend, sell only. Don't fight it. Now, if you're someone who prefers a purely objective, mathematical way to define this structure, you can absolutely use an indicator. Using a 200-period moving average acts as a fantastic long-term guideline. Because it averages out the price over the last 200 periods, it effectively smooths out all that daily noise. The rule of thumb here is super simple. If the price is hovering above the 200 moving average, consider yourself in an uptrend. If it's below, you're in a downtrend. Okay, so you've nailed down the trend. Awesome. But honestly, that's only half the battle. The immediate next hurdle is precision. Where exactly on this chaotic chart should you actually execute your trade? Which brings us perfectly to step 2, area of value. Think of this step as your absolute safeguard against blindly buying high just because a strong trend exists. We are looking for highly advantageous zones using support and resistance. But here's a pro tip. Instead of just playing the standard bounces, watch for the flip. That's when a stubborn ceiling of resistance decisively breaks. Market psychology shifts, and it suddenly becomes a prime new floor of support to buy from. Now, here's the thing. Areas of value don't just have to be boring horizontal lines. In a strongly trending market, a 50-period moving average can act as a dynamic, sloping area of value that the price bounces right off of. But there is a strict rule here. You must confirm it first. Please don't blindly trust the line. Wait to see if the price has successfully bounced off of it at least 2 times previously. Once you have those 2 tests, you can confidently use it for your 3rd or 4th entry. Right, so at this point, we know the what from our market structure, and we definitely know the where from our area of value. But pulling the trigger still requires exact precision. How do we determine the exact moment to click that buy or sell button? Let's get into step 3, entry triggers. To really pinpoint our timing, we're going to zoom in on short-term price patterns using candlestick charts. Now, don't just see these as random shapes on a screen. You need to read them as a localized war between buyers and sellers. We aren't just looking at the daily opens and closes. We are hunting for extreme rejections at those wick highs and lows to see who is actually surrendering. When you hit your area of value, the winner of that war becomes pretty obvious. Take a bullish hammer, for example. Sellers get completely exhausted pushing the price down, and buyers violently overwhelm them to close near the highs. Boom, that's your trigger. Conversely, a bearish shooting star shows an early bullish push getting absolutely crushed. That violent rejection, that's your immediate signal to short. So, you've checked the trend, you've found value, and you spotted that perfect candlestick trigger. But let's get real for a second and pivot to the ultimate, unavoidable reality of trading. Sometimes you're just going to be wrong. When the market inevitably moves against your flawless setup, how do you survive to trade another day? This leads us right into the final and maybe most crucial step, step 4, planning exits. Because let's face it, a perfectly timed entry literally means nothing if you don't know where to get out. To manage risk objectively, we use something called the average true range, or ATR. It's purely a volatility indicator. If the market is moving in wild, massive daily swings, your ATR goes up. This simple math is essentially your secret weapon for calculating a dynamic, smart stop loss. So here's the core rule. Place your stop loss exactly 1 ATR beyond your area of value. The logic here is absolutely vital. Your stop loss must be placed at a level that explicitly invalidates your trading setup. By placing it 1 ATR below your support level, you're giving the trade mathematical breathing room to endure normal daily volatility. If that line gets crossed, it's not a fluke. The setup is destroyed and you get out safely without second-guessing yourself. Now, on the flip side, when you're actually right, you've got a choice to make on taking your profits. Swing trading seeks to capture one quick, clean move, getting you out right before opposing pressure steps in. It gives you a really high win rate, but you're taking smaller gains. Trend following, however, attempts to ride massive, long-term moves using a trailing stop loss. It requires a psychological fortitude to sit through some genuinely painful pullbacks, but hey, the payout can be massive. You've just got to pick the style that fits your own psychology. All right, let's put this entire machine together. Structure defines your trend. Value pinpoints your bargain entry. Triggers confirm that momentum shift, and exits, they protect your capital while defining your targets. You now have a complete, totally objective system to execute on literally any chart you pull up. So the knowledge is now totally in your hands. The only thing left to ask is this. Are you going to keep treating your charts like a soup with way too many chefs, randomly adding indicators and just hoping for the best? Or are you ready to build your portfolio with a professional blueprint? Take this 4-step framework, clear off your screens, and apply this exact logic to your very next trade. Thanks so much for joining us on this explainer, and we will see you next time.